What's the difference between a bull and a bear market? Let's break it down. A bull market is when prices are rising. This creates a sense of optimism and encourages investors to buy. As more people buy, prices increase even more, which leads to more buying. It's a self-fulfilling cycle that can lead to a bull market. A bull market can last for years, like the one we've been in since 2009, or only a few months. A bear market is when prices are falling. This creates a sense of pessimism and causes investors to sell. As more people sell, prices drop even further, which leads to more selling. It's a downward spiral that can lead to a bear market. A bear market can last for years, like the one that we were in from 2000 to 2002. So what's the difference? The duration? A bull or bear market is officially declared after the fact. When a market goes up 20% from its low, we call that a bull market. When a market goes down 20% from its peak, we call that a bear market. Here's a table that shows the difference between the two. So how do you make money in each one? In a bull market, you want to be long, meaning you want to buy and hold. Research has shown that the longer you hold on to your investments, the higher the likelihood that you'll make money. In fact, if you had just held on to your investments for 5 years, you would have made money in every single year going back 20 years, even in a bear market. You still want to be long, meaning you want to buy and hold. The key is to have a diversified portfolio of low-cost index funds but there are times when it might make sense to go short, meaning you want to sell and wait for the market to go back up. For example, if you think that the market is going to crash, then it might make sense to go short. But if you're a long-term investor, then it probably doesn't make sense to try to time the market. Instead, you should just keep buying and holding. So what's the takeaway? Don't panic, sell, stay calm, and carry on. Well, except for this time, don't stay calm. If you don't have an emergency fund, then you need to build one. That should be your top priority. And if you have high interest rate debt, then you need to pay that off. That should be your second priority. After you have an emergency fund and no high interest rate debt, then you can start thinking about investing. And if you want to learn more about investing, then we have a ton of free resources on our channel. So what are you waiting for? Go check it out.